Thursday, January 29th, 2026. My name is Francisco Gaffney, and this is my daily streaming all about governance, risk, compliance, and advisory boards. So let's look at today at connected TV, and is where a lot of board decks go to die, if you may. So because they have big numbers, big screens, big promises. So today I want to keep it simple. Uh, what's the opportunity most people miss? It's not that the market size, which is huge, is the deal structure and the compliance realities that determine whether you can actually monetize. And the key word here is compliance, because I look back to this word because it's not what it looks like in terms of monetization, distribution, and revenues. So the context today is to provide this example is a live listed London Stock Exchange company I'm watching and using as an example to illustrate these points. The group still runs its digital media publishing business, mainly aimed at gamers, trading card games fans, and entertainment news. So they still run the digital media publishing, and they have also moved into AI. They license an advertising technology AI product for connected TV with an option to buy it and set up a 51% owned subsidiary to build the AI tools for supply chain and field services. So they are diversifying, they are restructuring. So after this restructure, they say they have shifted from stabilizing to growth plan. And mostly built around an exclusive license for their contextual advertising technology. They buy an option that was valued at zero for now because the outcome is uncertain, etc., etc. So they have a lot of moving paths, but today is stabilization done, growth plan going around licensing. Now, remember, this is a market of entertainment, it's distribution of advertising. So three problems that I see with this situation. Problem number one is distribution is changing and it's changing quickly. And we say distribution, you can imagine any shows or TVs or series that you watch on your screen. The Ofcom, which is a UK regulator for communication service like TV, phones, broadband, etc., issued a connected TV plan report noting that by the end of 2023, 86% of the UK primary TV sets could be used to watch TV online. And that's 86% of UK primary TV sets. That is a real shift in how audiences are reached. And now it starts to make sense what I mentioned in this context before. So licensing to distribution, AI advertising, contextual advertising, etc., etc. So why, you say, what is the problem? 86% of the TV sets. It is a problem, and you will see how in a second. Remember the word compliance? The second problem is licensing and options deals can look low risk until you read the notes. The company I'm watching disclosed a call option to buy 100% of a UK ad technology firm exercisable for 10 years at an exercise price of £2 million in cash, but alongside an exclusive license to commercialize the technology. That's why they are diversifying also into distribution and operations. Problem number three is the uncertainty is the point, not the footnote. And here's why. The same disclosure states that the largest company had generated no revenue as of June 30th last year, 2025, and that the directors considered the fair value to be nil due to this uncertainty. So what all this means? It means that, in other words, imagine the connected TV market, which is 85% or 86% of the TV sets in the UK, are prime time real estate, meaning a building in Mayfair in London in the UK. A license is a rental agreement, really. You have certain control of it, but an option is the right to buy the building at a later date. Now, if you are a director, the board question writes itself, I guess. So what do we control today? What do we pay for today? And what do we only get if everything goes well? And everything goes well, you say, well, but if everything goes wrong? Yeah, it's true. What happens that too. So remember compliance? Here's a massive bottleneck on this. You have a advertising media company, you have your audience, then you buy this AI technology, you go into licensing for distribution, and then there is a privacy issue or a privacy compliance requirement. The bottleneck. The Information Commission's office is clear on cookies and similar technologies. You must tell people if you set cookies, explain why, and get consent unless exceptions applies. That matters because the connected TV advertising and measurement often use device-based technology, right? So you have the permission to distribute. It doesn't mean that you have consent to advertise to these people and to this massive audience. So as a board advisor, what I would propose to consider in this case, and remember that this case is to exemplify when you have a big market, a license or a right to commercialize, but then you have a regulatory compliance bottleneck. So treat it like that because you can transpolate this example to anything that you are working on. As an advisor, I will suggest three things. One, separate commercial rights from commercial outcomes. A license gives you permission to commercialize. It does not guarantee distribution, revenue, or margins. So treat projections as scenarios, not as a forecast, because if you're going to forecast something that actually is licensed with permission to commercialize, it doesn't mean that you're going to sell it or commercialize in terms that you're going to deliver a service that is going to produce a revenue and a profit. So that's what the scenario is, a projection, it's not a forecast. Suggestion number two, insist on board level control maps. In this case, for any connected TV push, list what you control. Is it the inventory, the data, the pricing, the measurement, the consent capture, and what is the partners dependencies, and anchor all of these on the Ofcom descriptions of the connected TV platform layer that sits between viewers and content. So suggestion number three, build privacy compliance into the product plan. Use the Information Commission's Office cookie and storage guidance as acceptance criteria, not as a post-launch patch. If consent rates drop, your measurement weakens, and your unit economics change. What that means that actually you can distribute, but you cannot show the advertising, for example, to anybody. So yeah, they consume the content, but you cannot show them your sponsors or advertising to anybody. So what a shift, isn't it? So from licensing, advertising, distribution, 86% of the market, and now all of a sudden, a little consent from GDPR can literally skew all your projections or your forecasts. So this is where the good boards earn their big money. You don't block innovation, you stop the company from lying to itself, right? And remember this, you can transpolate this example to anything that you're dealing with now. If the deal is structured as license now and buy later, you ask, what would make us exercise, right? So if we're licensing, but then we buy, what would make us exercise? What will stop us to exercise that? What happens if we never exercise? Because then you have a finite business. In 10 years, it's gone. So what data and rights do we have in each scenario? So why this stop the company from lying to itself approach matters? For three things: the outcomes, the differentiators, and the risk reduction. In terms of outcomes, back to the example of the connected TV, you get a connected TV deal and governance checklist covering licensing options, controls, and consent dependencies, so you can run a sharper strategy review, right? So you need to review how your strategy goes, but you need all these controls. In terms of differentiator, you use real listed company structures to keep the discussion grounded in board decision points and not hype. Remember, you have an option. It's a license with an option at a zero value today. So in terms of risk reduction, you bake into UK regulatory expectations, including the Information Commission's Office guidelines on cookies and similar technologies to commercial teams. So the commercial teams are not forced into the late rework. So imagine the commercial teams start to launch a campaign and then they have to step back, rework everything because the consent was not baked into the offering. Now, One action you can take home today and is doable in 30 minutes or less. Take your CT connected TV plan or equivalent and write two versions of the unit economic. This is important thing. So one is assuming high consent and stable measurement, and the second thing is assuming low consent and weaker measurement. And then note what you would change in products, pricing, and partner mix to make the low consent case viable. So at least you have a best case, worst case scenario. So let's pause it here today and reconvene tomorrow, because tomorrow I will wrap up the week. I've been talking about these challenges of restructuring, and I will put together showing how alternative investment market rules and the Quoted Companies Alliance Corporate Governance Code shape what good governance looks like during a turnaround, including how you frame risk, choose KPIs investors can trust, and keep disclosures consistent while the operating model still changing. Have a great day, and I'll see you tomorrow. Thank you. Bye.